Today, we're going to talk about where to aim your guns, targeting the acquisition marketplace hotspots. And at the end of the session today, I'm going to have 5 different opportunities that I'm going to discuss with you that are pure gold. And you're going to want to have a clear image of these 5 opportunities because they're going to open some huge doors for you over the next year and maybe 2 years as well. So with that as introduction, here's what you're going to learn today. Why 2025 is a historic moment to buy a business. How to capitalize on the boomer business exit wave. How to use AI and automation to boost value post-acquisition. What Trump's new tax bill means for buyers and owners. Where energy deregulation is creating acquisition gold mines. Why tech investment is rising, even in a cautious economy, and how you can be a part of it. How to compete and win, even when private equity is circling. And by circling, I mean like vultures circling above the carcass, right? Private equity companies are very involved in buying businesses right now, but you can compete with them, and we're going to show you how. And then as a bonus today, after a brief Q&A session on the first part of this, I'm going to go through with you 5 high leverage, pure gold opportunities. They're going to reset your mind for how to go after the real gold out there. Okay, targeting acquisition marketplace hotspots. And the first one we want to bring to your attention today is what I refer to as the silver tsunami, and it's cresting. Okay, now what is the silver tsunami? Well, boomers are silver, right? Gray hair. There's this boomer exit wave. And think about this, 10,000 plus baby boomers retire every day. And that translates into 1,900 plus per day of them who are business owners. And their businesses are getting put on the marketplace, 1,900 a day. That's a huge amount of companies. And if you think of it over the next 5 years, that's millions of businesses hitting the market, millions. And there's no reason you shouldn't be buying at least one of them. It's a $10 trillion transfer of ownership by the year 2030. That's 5 years. That is such a huge opportunity. It defies ordinary description. That amount of wealth changing hands, and with the knowledge that you have through your Bizar financing, you are in the perfect position to get your share of that $10 trillion. It's there for the taking. Somebody's got to buy it. Some of it will be inherited by their kids, but the majority of it's going to go to buyers. And there's no reason it shouldn't be you. So this is a once in a generation buyer's market. There's going to be more businesses on the market than there are buyers, qualified buyers to buy them. Once in a lifetime buyer's market. Okay, why this is your window. Okay, most business owners lack a succession plan. They're so busy building their businesses, making money day to day, that the next thing you know, 20, 30 years have gone by and they haven't planned the succession for their business. Valuations are negotiable with motivated sellers because they don't know what to do. They just know they're retiring. Some of them are sick or have other financial conditions going on in their life, and they're motivated sellers. And financing terms favor creative deal making. You'll see that a little bit as we go into this, but sellers care more about continuity than top dollar cash. This is one of the biggest misconceptions that people have when they look at buying businesses. They think that it's the top dollar that's always going to be the winner and buy the business, and it's not. That seller usually cares about the business. He cares about his employees. They care about the community and the people that they've developed relationships with as they've built this business over a fairly long number of years. And the buyer who's going to be successful most often is not necessarily the high bidder, but it's the one that forms the cosmic bond with the seller so that the seller sees that buyer as the party they want to own their business because they believe their value system and method of proceeding with the business will be most consistent with how they built it. And so I want to, again, encourage you to look at this differently than that you don't have to have the most money to buy the company. AI, the acquisition multiplier. Tech-driven takeover advantage. Okay, what does that mean? Tech-driven takeover advantage. I don't know if you're an expert on tech, but the more you know about it, the more experienced you are in it, you're going to have an advantage. 50% plus of small and mid-sized business owners are unsure how to use AI. They don't know about this stuff. They're not tech folks, and they don't know how to use it. And AI enables lean, high margin operations. So they're missing this. And by using automation to cut SG&A and grow EBITDA fast, okay? So you're going to want to look at how you use automation to cut down all of those expenses. And that's going to help you to grow your EBITDA. You can also use automation to improve marketing. So these are all things that if you're tech savvy, you're going to have an advantage out there that the older generation doesn't have. And when I say tech savvy, I don't mean that you're a genius in this. I just mean that you're up to speed and up to date on what's going on. You know where to find resources when you need them. You're not afraid of AI or automation or the technology side of life, and that you're willing to go into that business that's owned by an owner who is clueless when it comes to technology and have an opportunity to apply that new technology to the improvement of that business in both expense reduction and increased marketing and sales. Create value from what sellers see as a threat. They see this stuff as a threat to their business, and they are paranoid that it's going to impair their business. Well, when you come in as the new owner, you're not afraid of all this. You're going to use it to propel that business to new heights and put value into it after you buy it that you don't have to pay for before you buy it. The AI acquisition multiplier looks into the real world applications where you automate back office accounting and HR, predictive inventory and dynamic pricing that makes that possible. AI chatbots for 24/7 customer support. We use them now. If you call our company, you don't get a real human being. Sorry, guys, you get AI. And the AI has been excessively trained to do everything that a human can do to make sure you get the highest level of customer service. And most importantly, when you need to talk to a real person, it's going to know that by the training it's had, and it's going to make sure you get to the real person in our company that can give you the information that you really want or carry on the discussion that you need. Use AI for due diligence and acquisition targeting. We use it here all the time. These are advantages that you have today that if you're not embracing them, shame on you. If you're a younger guy and you're okay with your phone and technology and AI and ChatGPT and Perplexity and Grok and all the new stuff that's out there, if you're getting comfortable with all that, you are so far ahead of the game, and you're going to want to use that to advantage yourself when it comes to acquisition. The next item that you want to look at in terms of how you target the businesses that are in the hot spots right now is take a look at this thing called the One Big Beautiful Bill. And the question you might ask, is this fuel or is it fire? Both. Okay. Well, what's in the bill? All right. Well, we've all heard about this thing. It exempts tips and overtime from federal income tax. So what? It cuts corporate and business income tax rates. That's a big so what? Because it means when you go into this business in after-tax dollars, it's going to produce more for you even before you change anything or improve anything than it did for the owner. And that's because your rates are going to come down. Massive increase in infrastructure and defense spending. Well, you're hopefully, if you've got some radar, right? You're going to start to look at what kind of businesses are out there being sold by retiring baby boomers that have a potential to tap into this massive increase in infrastructure spending and defense spending. That's where I'd be targeting right now if I'm looking for a small business. Designed to spark GDP growth in 2025, 2026. So during that period of time, it's designed, built to stimulate GDP growth. And in stimulating that growth, you want to position yourself in front of that expenditure because you will clearly be benefiting from that. The strategic impacts of the One Big Beautiful Bill are short-term tailwinds, but long-term debt clouds. It's still not certain that this big, beautiful bill won't raise the national debt. And the only reason it won't is because it's successful at helping businesses grow so quickly. Increased income and increased commerce produces enough new tax revenue that the debt is overcome, that the negative impact of additional debt is overcome. That's what the administration is betting on. And so the chances are, knowing Trump's track record, I wouldn't bet against it. And everything that I see Trump doing in his policies are telling me that the long-term debt is not going to be there. It's going to get overcome by the growth that's going to be a product of this One Big Beautiful Bill. Owners benefit from this bill more than employees, okay? Under the new tax code, employees are going to benefit, okay? Especially if they get tips and work overtime and all that stuff, they're going to benefit. And even the ones that don't are going to benefit. But the big winners are going to be business owners, and you want to be one of them. Buying now locks in favorable pass-through income treatment. Okay, so you're going to have the benefit of these tax provisions that were not available to the former owner and are not priced into the value of the business. And you want to be able to structure deals to maximize new tax efficiencies. So understanding the bill, taking some time to research it, go into ChatGPT, put in one big, beautiful bill, ask it, how do I benefit from this bill? You should be doing that. And you should be drilling down with ChatGPT or with Perplexity or with Grok or any of the other AI engines out there to be looking at these types of factors that we're discussing here today, and take your own time to research and drill down to how you win based on these bills. Just have a dialogue with it. It's like a PhD person that you have access to, and you can just talk to it, right? Or chat with it using your fingertips. Use it to drill down to specific businesses that you want to consider or undertake. Another area is deregulated energy, and that equals acquisition gold mine. The policy shifts are huge in this, are huge. And these policy shifts are in motion. There are executive orders for fast-tracking energy permitting. Why does that matter to you? Because there's going to be an explosion in energy-related industries. You may not want to buy, you may not think you're going to be able to buy Exxon or the big oil companies, but these big oil companies live off of an ocean of service providers that are tied to them and who prosper when they prosper. They're coming off of hard times. The businesses that serve those energy producers are coming off of hard times. Their valuation is low because the valuations are based on past earnings. So if you're buying those businesses now, you get to own them through this policy shift and their growth, because your growth will be tied to their growth. So there's a huge opportunity for you in businesses that support the energy industries. Executive orders are fast-tracking the energy permits, and that's to your advantage if you're pursuing this course. Reduced regulatory burdens on domestic energy firms. Well, that not only includes the big energy companies, but includes all of their service providers too. The companies that provide products and services to the energy industry are all going to benefit from this. And incentives for innovation in oil and gas, renewables, and services. All of this stuff is fuel for the energy industries. And there are tailwinds for the adjacent industries too, that are not even directly part of the supply chain, but do get involved in maintenance and logistics and staffing and all of the services that go into supporting the energy industries. Huge opportunity here. I mean, it's the biggest you'll ever see in your lifetime for these industries, because you're coming off a depressed industry from the last administration to a promoted industry from the current administration. The flip and the increase in values that will occur to those firms supporting all of this are literally unprecedented. Now, this whole idea of deregulated energy equals acquisition gold mine has a downside to it, okay? Because when there's huge opportunity, you won't be the only one going after it. You're going to be competing with PE capital, private equity capital. So how do you win? How do you beat out the PE capital folks? All right, well, you focus on service providers too small for the PE radar. They're not interested in companies that do less than 20, 30 million a year in sales. It's too small for them. So guess what? That leaves everything below 20 million a year in sales, almost everything for you. And if you're a graduate or a member of Bizar Financing, well, you have all the knowledge and the tools to go after these, more so than 98% of all the other potential buyers out there. And so the thing you really need to realize is that while there are people who are dreamers out there and want to go after these businesses, they don't know all that much. And even people who own businesses themselves don't know how to buy them. They don't even know how to sell them. This is not what they do. They didn't take Bizar Financing. They don't understand leverage the way that you do and have the ability to go after these companies. What do you have to offer that the PE firms don't have? Well, offer speed, certainty, and seller-friendly terms. All right? There's no reason you can't negotiate good terms with the seller that are friendly to them and friendly to you as a buyer. And certainly you can move faster than the PE firms who are bureaucratic, even at the smallest level of them. They're not entrepreneurial like you. They don't have the ability to move quickly. And emphasize shared upside, not just cash up front. When we're structuring deals right now, we're structuring so that the seller stays in for some of the equity retention in the company. They stay on for the next 2 to 3 years and manage the company during that period of time At the same time that in your case, they might be transferring all the knowledge of the business to you. But in the meantime, they're really heading up the operations. And with the plan that you can present to them, and I'm going to go over that plan with you briefly today, you can emphasize that they're going to share in the upside as you are going to direct that business into the future with your knowledge of AI, with your ability to bring new technology, with your ability to increase sales. You don't have to sell yourself. Okay. Why are you buying this business? You're not going to buy it to keep it the way it is. You're going to buy it to grow it because you got ideas, you've got concepts, you've got strategies, many of which come out of Bizar financing, many of which are your own. But you're doing this because you're optimistic about your ability to grow this company way beyond what the original owner did. Well, you're going to sell them that. And you're going to show them, here's what I'm going to do for you. And you're going to come along with me as my partner for the next several years. And you're still going to own 20, 30% of the company. And as we grow it together, you're going to win. I'm going to give you cash up front, but you're going to get a big piece of the business to retain. And then when you come out of that in 3 years, that will be worth more substantially than what those shares of that business are worth today. And you're going to win with me when I grow this company and when we grow it together. Leverage ecosystem strategy to outmaneuver big capital. Most big capital is going to come in with a buy and flip mentality. They're going to buy it. They're going to want to run it. They're going to want to see if they can grow it, but that's not their main effort. They're going to want to see how they can drive down the price on the buy and build up the sell a year or 2 or 3 later at the most. And so they don't care about the company. They don't care about the owner. They don't care about the employees. They don't care about the legacy of the business and the owner. They don't care about any of that stuff. They're just there for the money. They've got to invest their money. They're going to buy the company and flip it. That's what they're going to do with it. And the owner is paranoid over what that PE company was going to do to their legacy business that they've given their blood, sweat, and tears to build all these years. Well, you're going to position yourself in a way that you care about all that stuff. You're there to make sure that the owner not only gets his money up front, not only gets a win on the backside, but they also participate in the solidification of their legacy so that when they're gone, everything that they dreamed about and built into that business, you're carrying on. That's their big win. And they'll give you a preference over the PE company, even if the PE company is coming in with more money. Tech investment in an uncertain market, another hotspot. Okay. And the trend is clear. Tech investment continues despite what some perceive as a GDP slowdown. Gross domestic product, in case some of you are wondering what GDP stands for. Gross domestic product has slowed down in some areas. In some areas, it's been looking at as an increase. I'm betting on that it's going to increase. It's not going down. There's too much good stuff happening. And digital first firms outpacing analog competitors. So sometimes there's an opportunity to buy a digital version of a company that has the ability to outpace its analog competitor. Sometimes you're going to buy an analog competitor and convert it to a digital company. And that'll help to increase its output and all of the things it can do to reduce costs. If you don't understand what digital and analog is and the difference between them, look them up. Go into the AI engines and identify what companies are digitally based, what companies are their analog competitors. Start asking questions. Get good at asking questions of ChatGPT. You'll find that you get involved in it. It takes you and helps guide you in the direction that you need. It gives you solid information for making decisions. Great tool. You want to use it. Efficiency, scale in margin-driven acquisitions. Okay, so you have efficiency that increases scale in margin-driven acquisitions. You will be buying businesses that have margins that have been traditional for years. And in good times and bad, those margins shrink and expand within a certain range. But the minute you start applying technology, those margins start to increase. And the reason is the products are already priced in the competitive marketplace out there. And as you build your margin, then your price will remain relatively stable, but you'll bring down your costs, but also use it to leverage your ability to market correctly and using the social media tools and all of the ways that there are to improve and increase marketing. And all of a sudden you find yourself in so much better position than the owner was. Amortizing your debt service that it took you to buy this business become easier as you increase your margins. Increase margins just make debt reduction easier and faster. And it's that much quicker that the business is free of debt and producing massively for you. Strategic tech buyers are snapping up lagging firms. Some people tell me, well, why do I want to buy this lagging firm? Well, it's got a place in the market. It's got customers. It's got expenses that it incurs that you can reduce. It's got methods of marketing that you can improve. The fact that the firm is lagging, that's only because you're not there. So if you're going into a business because you know the industry, you know the business, you're hip on all the latest technology, well, you can go be an employee for somebody else with all that knowledge and you're not going to make bupkis, as they say. On the other hand, you can take that knowledge and leverage it into your being the owner of business and take a lagging firm, provide advantages to it, keep the owner on as a junior partner so that they share in the upside with you, but they're there to help you run the business and transfer it. So you need a strategy that enables you to go into those lagging firms and utilize your updated knowledge to totally turn those companies massively profitable. And you win, you're buying them at a low valuation, and then you're turning them into high valuation companies by the addition of your knowledge and your abilities. It's all part of the game. Your competitive playbook, what does that look like? Well, you're going to buy a legacy business with a predictable revenue. Okay, that's how you start out. Why do you want to buy a legacy business with a predictable revenue? Because they're easier to finance. You buy a business that it doesn't have predictable revenue. Nobody's going to lend you money to buy the business. They don't want to take the risk with you for that. They want to buy businesses. They can look at the history. The seller's going to stay on and run it for a period of a few years. They feel very confident in that. And so you can now leverage financing out there better than if you're trying to buy something that has no history or no predictability to it. Then you're going to add AI and automation to streamline and scale that predictable business so it outproduces its predictability. Okay, all that inures to you, that benefit. And you're going to create 2 to 3 times EBITDA growth with basically limited capital. That's what tech investment in an uncertain market can do for you. Okay, that's what it can do for you. And you want to position yourself as a tech savvy acquirer in your industry, because now you've got whatever the industry is, it's got resources, it's got people that like it, it's got lenders that lend in it, it's got people who invest in it. All those things are out there. And when you position yourself as a tech savvy acquirer in your industry, now you're giving yourself an edge on just people who, quote, are experienced in the industry. Here are the key takeaways from what we've covered so far. Key takeaways. There are 1,900 plus boomer-owned businesses that hit the market every day. Every day. That's awesome. And yeah, it's a big country. Yeah, there's a lot of cities out there that's spread over, but they're happening every day. And there's plenty there for you. AI and automation are not optional. Okay, that's a takeaway here. They're not optional. They're acquisition accelerators. You cannot afford to look at buying businesses thinking you're going to run them the same as the old owner did, because you will be swept away by the competition at some point in the future when those buyers and maybe younger sellers are embracing AI and are automating those companies. So you have to be willing to be part of that dynamic. Trump's tax plan rewards ownership, not employment. The big winners over the next 4 years and probably beyond are going to be business owners. And you want to be one of them. Here are in Bizar Financing are all the tools you need to do it. Energy and the service sector are opening up due to deregulation. Deregulation is the biggest profit potential producer of all the things going on, because reduced taxes only help you when you're making a lot of money. They don't help you to make money. Deregulation does. It enables businesses that have been so absorbed in compliance to regulatory issues that they haven't been able to make money because they're so restricted in what they can do and how they can do it. Well, when those regulations go away, they're going to start making money. Then taxes become important. But the most important thing that you have to worry about now or benefit from now is the deregulation. That's going to take these businesses and allow many of them for the first time to start making meaningful money. Tech-forward buyers are thriving even in uncertain markets because the application of the technology can take companies and industries that have lousy margins, aren't profitable, and by driving down costs and improving the ability to market, make all the difference. And you start adding all these factors together, the win for you in buying a business is huge. You can compete with private equity by being faster, more flexible, and relationship driven. You want to engender yourself to that owner so that they see you as the buyer they want to sell to. They see you as the buyer they want to be partners with for the next 2 or 3 years as they're exiting the company, working with you to build up its value so that their final sale, the final portion of the exit that they're going to take, that business will be more valuable than it was before by a significant amount. And you're going to position yourself because at that point, you should have a lot of your debt paid off from the acquisition of this business in the first place so that you can now, through a note, buy out the rest of their business, right? But that is much higher value, which is fine with you because the cash flows are there to pay for that. Okay. So everybody wins here. The seller's going to win. They're going to get a bigger bite at the apple. The second time, they've got a nice chunk of security money that comes out with the initial purchase. You win because you get a partner who's going to help you build the business. You win because you're going to take your technology know-how, infuse it in the business. You're going to work with the seller. You're going to build up the company. Everybody's going to win, from your employees to your suppliers. The only people that aren't going to win are your competitors, because this is why you're doing this, because you know what it is that your strategy and plan is. And that's why you're going into business in the first place. Okay. That's really important. So these are your key takeaways from what I've covered with you so far. Now, what about the promised 5 high leverage, pure gold opportunities? Well, we're going to cover those, but we're going to do a quick Q&A break here first. And then when we've answered your questions, I'll get into these pure gold opportunities. They're coming right after the Q&A. So for those of you who have questions, this is the time for you to raise your hand or just put a question in the box there. They could type your questions in. How, as a non-U.S. citizen, buy a business as we cannot use SBA? Okay, so if you can't use SBA, you know what? You're lucky. I hate the SBA. Now, it is a valid source of financing for buying a business, and a lot of folks use SBA loans. I don't like them because I refuse to sign personal guarantees. I just have an aversion of them, and so I avoid them. So it causes me to use all of the other techniques that we teach here in Bizar Financing. So if you are not a U.S. citizen, that's not a problem. Now, there's another answer to that. There's nothing that says you can't have a U.S. citizen as a partner, right? Okay, so it's you own the business and a partner owns the business. And it's the partner who applies for the SBA loan as opposed to you. So you can still get access to SBA financing. I mean, you've heard me say this dozens of times. Business is a team sport. Just because you don't know how to do something, or just because you don't have a certain resource, doesn't mean you can't partner with somebody who does, right? Okay, so some of your challenges you're going to solve by hiring employees, and other of your challenges you're going to solve by finding partners who you and they can work together to accomplish a common objective. All right, so this is the next question here, of all the AI platforms, which is the better one for the LBO type question? Well, I can only tell you that I use ChatGPT most, and I use it because it was one of the first ones to be out there. And I very thoroughly educated my ChatGPT to understand leverage buyouts, to understand our techniques and our methods, and to think in terms of their use, in terms of all the examples that I also brought into my ChatGPT. So my ChatGPT is not only a PhD in all of the other fields, but it is a double PhD in leverage buyout. So I can get very efficient use out of my ChatGPT. But I still use Perplexity for some types of things. I tried putting my questions and my thinking into both. In other words, I use Perplexity and ChatGPT, and I ask them the same question. And I look at the difference in the answers. And I found that over a long period of time, ChatGPT gave me my best answers. However, at this point, I don't know whether that's because ChatGPT is better or because my ChatGPT has learned more than my Perplexity GPT or my Grok, or there's a number of other ones. I'm not really fond of Gemini, and that one I found is not efficient or for me. But Perplexity and ChatGPT are more aggressive in finding answers. And it also means that they actually have a tendency to sometimes be wrong more than the more conservative AIs out there. But I don't care. I'd rather have the more aggressive, and then I'll double research their elements and the facts that they produce or say to just double check to make sure that those things have been considered. But I like the more aggressive nature of Perplexity and ChatGPT. All right, let me move on to the pure gold. Okay, so what about the promised 5 high leverage pure gold opportunities. Well, here they are. One, seller finance deals are at an all-time high. Even back in the day, when it was very early in Bizar financing, when the prime went to 21%, and you couldn't sell a business without an extensive amount of seller financing to bring down the overall interest cost, because institutionally, you're going to be paying 20% minimum for your money and sometimes 25 to 30% for your money, which was outrageous. So the only way you could get your interest cost down were to get your seller's financing down around 5%. So that when you looked at your blended interest rate between what you were paying on the seller portion of the financing and what you were paying on the institutional portion of the financing, you were probably at 8 to 9% of the total financing as your interest rate, right? So you could live with that, okay? Well, today, even though the prime isn't anywhere near that high, and even though institutional rates are nowhere near as high as they were back then, there is more seller financing happening right now because of the boomer marketplace where there's more businesses on the market than there are qualified buyers. That's driving down the seller's interest rates and their willingness to finance an even higher amount of the purchase price. So you're going to want to participate in this seller financing boom and use it to the advantage of what you're purchasing. Now, why does it matter? With high interest rates and cautious lenders, so this is what you got out there right now. Sellers are increasingly willing to finance part of the deal to get it done. Especially true for baby boomer owners who want a steady retirement income. You see, part of the way that the owner of that business was a retiring baby boomer who was looking at another 10 to 15 years of life potentially without an income, having this debt amortized to them over all that period of time is not a bane to them. It's something that they now can look forward to, the fact that they've got this. Now they're going to want to be sure that you're a qualified buyer. You're going to have to demonstrate to them that you're the right buyer for the business. But then using seller financing, once they have faith in you, it gets to be a whole lot easier. So the opportunity here is to position yourself as a legacy partner rather than a buyer and use that goodwill to negotiate seller notes, earnouts, and favorable terms. Okay? That's what it comes down to, that you are not just a buyer, you're their legacy partner. You are the vehicle through which their legacy will live on. It's not going to be torn apart by some PE firm who's going to come in, tear it apart, break it into pieces, flip it, whatever they're going to do with it, because their only goal is money. All right? So that's really, really important. All right. Number two, SBA 7(a) loans still offer leverage despite rate hikes. Why does it matter? SBA loans still offer 90% loan to value and long repayment windows. They make it favorable financing for the purchase of a business, even though their rates are still high, and if you don't mind signing the personal guarantee. In many cases, you can acquire a company with as little as 5 to 10% of the purchase price out of pocket, okay? Because you add in 90% from the SBA, okay, loan to value, and you leverage the seller for 10 or 15% of the sale price. Okay, you could actually end up with working capital in the company after your deal is done and maybe pull out some cash for yourself if you do it right. Okay, so still a great opportunity, guys. Still a great opportunity, and this should be weighed as a part of your decision making. And the opportunity is to combine SBA financing with seller carryback and a small investor group. And you can control a cash flowing business with minimal personal risk once you've done it right and you've got extra financing in there to help you stabilize and carry that business forward. So again, this is just a phenomenal high leverage opportunity. Declining valuations in certain sectors. Okay, why it matters. Sectors like retail, commercial real estate, adjacent services, those are businesses that service the commercial real estate marketplace, and logistics are seeing valuation compression. In other words, all this value hasn't been growing. It's been compressing due to recession and fears of cyclicality. Okay, but they're great businesses to go into, especially if you're applying all the techniques that we've been mentioning so far and all the other ones that you learn in Bizar financing. That makes otherwise great businesses undervalued relative to their real cash flow and cash flow potential going forward. And the opportunity is to acquire in temporarily suppressed sectors, then apply technology, rebrand, or diversify to drive new value and exit at a higher multiple, or live off the cash flow, whatever you want to do. But these present potentially great opportunities. Now, if the businesses are fatally flawed, and continuing to compress in valuation for a reason that isn't going to turn around, then you don't want to go there. But that's part of what you're going to discern when you're looking at these potential opportunities. Number 4 is invisible gold mines, businesses without a strong online presence. Why it matters. Many 55-plus-year-old owners have never embraced digital marketing, automation, or even basic CRM. They don't even know what these things are. They've just had their nose to the grindstone building their business in the old traditional way and fearing any of these changes because they didn't know about them or didn't understand them. But you do. And you have the opportunity to go into those businesses and then turn them into gold mines. They're generating right now maybe 1 to 5 million in revenue with zero digital leverage. Well, what happens when you go in there and digitally leverage that business? The opportunity is to apply modern sales funnels, SEO, or even a Google business profile, and you can often double revenue within 12 to 24 months. What a gold mine is sitting out there with owners who have neglected this or feared it so that they've avoided it for the last 10 or 15 years. What an opportunity those are. And you should be looking for them. And you should be going into those AI platforms and putting in questions to help you understand which businesses out there this applies to, where you're going to find them, how you're going to find them, questions you should ask the seller. Have a conversation with AI, make them your partner in finding these companies. Okay, you'll be empowered beyond belief. And number 5, supply chain localization and made in America resurgence. Why it matters. Trade friction, tariffs, and patriotism are fueling a renaissance for U.S.-based manufacturing and services, especially in the technology fields, especially there. But you don't have to go there. You can go to any business, stuff made in India, made in China, made cheaply. There's a new orientation for the American consumer. First of all, tariffs are going to change that difference in cost. The idea that it has to be shipped from a far off place as opposed to made locally is going to equate the cost between the foreign made and the US made products because it costs a lot of money to get the products here in shipping and fuel costs and all the things it takes to get them here, plus time. Time is money. So the difference today between getting products made in China and India and South America versus here, that price differential is not as big as it used to be. And now there's this tariff issue adding more benefit to making it here. And the fact that people are patriotic in the new environment, they're willing to pay a few bucks more for an American-made product to keep the employment here. They realize that there's a second benefit beyond just getting the product. When it's made in America, there's the benefit of having more people employed, putting tax revenue into the government, bringing down their tax burden because they got other people that they're helping employ who are paying taxes. All right. So patriotism has an economic basis to it. And all of those things are coming together to fuel this renaissance in US-based manufacturing. And you want to be a buyer of these companies and ride that wave into the future. Even federal and defense contracts are increasingly favoring US-owned companies, right? And federal and defense, especially because there's the realization that if you have the product made in China, you've got a security risk there if we go to war with those people and you can't get your defense products. And the same thing is even true of just helping to run the elements of the federal government. The idea that you don't want your products having a vulnerability to foreign adversaries. And even if they're not adversaries today, but who knows what they're going to be tomorrow. The opportunity is buying a US-based small to mid-sized business that serves government, military, infrastructure, or regional supply chains, positions you for major tailwinds in procurement and funding. Why funding? Well, the lenders understand that you are going to be riding a wave of increased demand for American manufactured goods. They're willing to lean in a little bit over the normal numbers that they look at from past performance, knowing that future performance is going to benefit from government policy. All right, last chance to ask questions. Hopefully this has been an eye-opener for you that has helped you to identify where the wins are going to be, what it is that you can bring to a company that makes the difference, what kind of strategies and techniques that you might want to apply to these companies that you're going to acquire. I would take this orientation that you have today, and I would use this as an opportunity to go back over your webinars that we've given you over these many years, hundreds and hundreds of webinars that are in your library, and now look at those techniques and the methods that you've learned and think about how you'd apply them in these new situations and update the thoughts that you had from the past to how they might now apply to today and the future. And I think you will hopefully have found that today was a very valuable session in orienting you to how you look to the future, how you find a business that's right for the future, and how you can acquire that business and leverage its purchase.